Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and it's Friday. This time we'd say TGIF for an end of not so active week. Before that, let's see what happened, and it's the tech stocks who thought of having the last laugh as they offset a slowing GDP number for the US economy. We have the PC numbers releasing today, giving some more hint on the US inflation. And if we have to talk about inflation, is the Tokyo inflation which is gaining momentum ahead of BOJ's meeting, while the labor market figures were also weakening. Basically, an accelerating inflation, yet the Barclays Bank PLC expects the Japanese yen to retake its crown as the haven currency, partially being led by the BOJ's normalization and the yen's strength observed during the risk aversion periods. On geopolitics, we have the China, which is improving their ties with Australia majorly on the trade and the investment fronts. So, JK, there's a lot of developments for the market participants to think on, and I'd like your take on these fronts as well.
Hey, good morning, Shikhar. Yes, as we got to the business end of the week, we had lots of numbers coming in from the US economy and more to come today, starting with, of course, the Japanese monetary policy decision, which is expected any time now. On the US economy, we had the mixed picture once again. The first estimate of GDP coming much lower than expected at 1.1% versus 1.9%, pulled down heavily due to lower inventory investment. And also, this was somewhat compensated by a higher consumption for the quarter, which was helped by January due to seasonal factors. However, the GDP data also showed an unhappy combination of softer than expected growth and stronger than expected price increases, because the core PCE deflator rose at 4.9% annual rate in the quarter, above consensus for a 4.7% gain. And this is something that Fed looks very closely at. The sharp subtraction from inventory also means growth outcome wasn't as bad as it looks on its face value, but the market focus was on the signal of stronger prices, of course. On the other hand, the falling weekly jobless claims to 230,000 from 246,000 shows continued strength of the jobs market. Will not help Fed to relax on inflation. They will have more data to assess today in terms of PCE core inflation. That's expected to moderate on year-on-year basis, but stay at 0.3% on month-on-month. They will also have a look at the employment cost index, which is more crucial, and expected to rise to 1.1% versus 1% last quarter. Again, this increase will not be to Fed's liking. The University of Michigan reports final number will also be announced today, with consumer inflation expectations, which had earlier in the month showed a big pop-up on the median figure from 3.6 to 4.6%. So all in all, nothing out of the data released in the last 1 week to 10 days shows that Fed will be on changing its course on inflation fighting, and 0.25% is given as a rise in May meeting, and what holds for the future meetings, it's really very, very uncertain, and we really have to wait for the data today and what Powell says in the run-up. In fact, in all the varying data actually keeps the policy expectations very uncertain. Although even the year-end rate cut expectations have been somewhat moderated now. The yields are obviously on a roller coaster ride, falling initially after the GDP data, but rising once again strongly, looking at the price increases and also after the jobless claims data. As I said, the expectations for 0.25% in May remain unchanged. The two-year yields rose 13 basis points to 4.08%, largely retracing the falls that we had seen on Tuesday and initially on Wednesday alongside the banking fears. Equity markets actually took a break from watching the banking crisis and even an economic number, as they got a big boost from the tech companies' earnings. After Microsoft's impressive numbers on Wednesday, Thursday saw performance of Meta platforms overshadowing concerns on the economic growth. Shares in Meta were up almost 13.9%, the highest level in more than a year. Apart from this, we also had Google and Comcast posting better numbers earlier in the week. S&P and Dow registered their biggest single-day percentage gain since January 6th, while Nasdaq posted its biggest single-day advance since March 16. European markets were also higher, helped again by better earnings from big banks. The global composite index of equity rose more than 1.5%, which is the largest rise in a day in over a month. Now, just for a perspective, despite all the negative forecasts, recession talk, banking sector concerns in March and also in this week, also rate take fears, you can look at S&P E-mini is just 1.5% down from the year high of 4,208 hit on February 2nd, and is actually 7.5% higher for the year. So who is talking of depression in the stock market? At least that is not visible right now. The US dollar actually strengthened alongside the yields on the back of US data, but has failed to hold on to these gains. And actually, it was flat for the day. And I would say even in Asia, it has been trading waters, waiting for the crucial BOJ decision, followed by important data from the US, which will hold a lot of water for the upcoming Fed meeting next Tuesday and Wednesday. Commodity currencies are still weaker overall because of the uncertain growth prospects for the world economy. As you said, the Tokyo region's inflation on both headline and core rose more than expected to 3.5% from 3.2%, and it generally precedes the trend of the overall economy. But I am almost certain that this is unlikely to push the BOJ towards any tweak in their policy for now. Speaking of yen, I would say the yen strength may come more from the dollar weakness as the yields eventually come down in the US and they move towards a pause rather than due to any tweak in the Japanese policy, which seems to be taking its own time despite all the rises that we have seen in the inflation numbers. As far as the rupee is concerned, we had one more attempt to break at 81.70 yesterday, as there are again a deluge of flows from mainly from funds raised from corporates abroad, and the nationalized banks not really keen to absorb them at higher levels. But once it hit the level of 81.70 or lower, they were back into buying. But interestingly, there were non-nationalized banks also who were buying yesterday, which pushed up the markets higher towards 81.85. And this was also blamed on some sort of end to the IPO related inflows, and possibly going forward we see some outflows related to the same after the listings are finalized. So but overall, after a break of 81.90, I'm getting a sense that the pressure on the USD INR is likely to the downside, subject of course to how the RBI wants to approach the currency rate, because we are having a prospect of global slowdown which can impact our exports, and it doesn't help us to have a strong currency. Secondly, some regional currencies like Chinese yuan and Korean won, which generally has some influence on the INR exchange rate, are also trading much weaker. So we may not have a big strength in the INR, but do not see significant weakness also, because the factors affecting the INR are mostly favorable for it, barring RBI's intervention. Thank you.
Okay, JK, and wonderful. Yes, folks, there is a lot of factors which are favoring, as JK mentioned, INR strength, but at the same time, there are factors like the weakening of the Asian currencies, be it the Chinese yuan or the South Korean wons. But one more thing which is seen is the possible recession fears, which will also put some sort of pressure on the currency as the exports dwindle. So the central bank need to figure out their approach towards currencies, volatility, and expectations. All said and done, there is one more quite interesting bit which JK mentioned, which is the wait for the forward guidance, if there's any from the FOMC meeting, shall give us the direction. But at the same time, it's the softer than expected growth and stronger than expected job and inflation numbers which will give some sort of actionable for the FOMC. And other than that, it's the European and the US markets both having better earning numbers posted, which has buoyed the equity markets to a rising direction. But all said and done, it's the end of the week and as well as end of the month, folks. So I hope you guys are thorough with your obligations for this month. That's it for today, folks. We shall be joining in on Monday with another round of updates. But before that, the Almus team is having a session with the CS Circle tomorrow. If you guys have any invites, do share and join us in our session on risk management and what are our expectations with respect to the financial markets and Indian markets. That's it for today, folks. Thank you.